Welcome everyone. Today we'll talk about gold. We'll evaluate if the bull market in gold has played out or if there is more room to run. We'll look at 5 reasons that can cause gold prices to crash and 5 that can help gold continue making new highs. One of those 5 is extremely likely to happen if history is our guide. To understand this evaluation, we'll look at the 5 reasons behind gold's meteoric rise this year. And stay tuned because one of the main reasons behind gold's exceptional performance is happening for the first time in history. Finally, we will compare gold with silver as an investment if we were looking to buy right now. Let's get started. There are 5 major reasons for the increase in price of gold, and the most important reason, and the one that has never happened before, has been gold ETFs. Global inflows into gold ETFs and other financial instruments have increased massively, reflecting strong investment sentiment. This is a chart that shows global ETF investment in gold, and you can see the consistent rise over the last 2 years. Just this year, $64 billion have flown into gold ETFs. While that may not seem like a lot, we must acknowledge that none of this is coming from large institutions or governments. They usually work with physical gold. This $64 billion is almost exclusively from individual investors. That is unprecedented and has been complemented by the second most important reason, which is the dollar losing its position as a global reserve. US dollar now accounts for less than 60% of global reserves, down from 70% a decade back. The reaction to the Russia-Ukraine war and President Trump's recent policies have further weakened the dollar's position against other major currencies like the Chinese yen. So, countries have moved to switch their reserves from USD to gold. India, for example, has increased its gold reserves by a massive 40% in the last 10 years. Similarly, China has increased its gold reserves by 10% over the last 2 years, while continuing to sell US treasuries. This hoarding of gold by central banks has been the primary reason for the consistency of this gold rally. It has been complemented by persistent global inflation, which kick-started the rally of gold in 2022. The weakening Indian rupee has added to this rally. The Indian rupee has depreciated against the US dollar and other major currencies, falling from around 73 to nearly 90 in recent years. Since gold is priced in dollars globally, a weaker rupee raises the local rupee price of gold, directly contributing to the surge. Global monetary policy tightening has also added to gold's rally. While high interest rates should ideally lower the prices of gold, the volume of rate hikes has brought about a volatility that can overshadow that effect, keeping gold prices elevated. Finally, ongoing geopolitical tensions such as conflicts in Eastern Europe and the Middle East act as safe haven triggers where gold is the asset of choice. But if all of this is known, then has the gold rally finally reached its peak? Well, there are risks that could cause gold prices to fall. Global inflation is easing and interest rates are falling. If inflation starts to abate faster than expected and central banks halt or reverse rate hikes, gold's appeal as an inflation hedge diminishes. Currently, Trump's tariffs have added to inflationary pressures, which has helped gold's rally. However, GST cuts in India could put downward pressure on inflation, which if sustained can lead to a large price correction in gold. The US dollar is also weakening because of Trump's policies. A sustained decline in the US dollar index would make gold less expensive in other currencies, potentially reducing demand. As President Trump and his associated have repeatedly stated, they wish to keep the dollar subdued, meaning gold prices could face another headwind from US monetary policy. Peace and geopolitical resolution, such as a resolution in conflict zones, could reduce safe haven demand, leading to price corrections. Here as well, the ceasefire between Israel and Gaza could impact gold's price negatively. Global economic recovery would also boost investor confidence in risk assets like equities, pulling funds away from gold. This is unlikely to happen since recession triggers are going off everywhere. This could then be the next trigger for a rally in gold. However, overbought technical levels and profit-taking by traders can trigger sharp corrections, especially if triggered by sudden macroeconomic surprises. This is the most likely reason for the recent correction in gold prices. But there are also multiple factors that might support further gold price increases. Persistent inflation and currency depreciation. If inflation remains elevated in India and globally, gold's appeal as a hedge will persist. The new tariff regime that we live in is not conducive to a deflationary environment. It is highly likely that we will see a high inflation period again relatively soon, which would support gold prices. Geopolitical tensions and global uncertainty. Any escalation in conflicts, sanctions, or regional disputes can drive safe haven demand, pushing prices higher. While Israel and Iran are currently abiding by the ceasefire, it is by no means a guaranteed peace. Our wonderful neighbors are also known to retaliate at least once after every crushing defeat. We must not forget, Russia and Ukraine are still at war. Global monetary policy is perhaps the underlying cause for gold's appeal. incremental easing or pause in rate hikes, along with high sovereign debt levels worldwide, might increase demand for non-yielding assets like gold. Gold as a hold of value does not depend on any government. As such, in periods of high volatility, it is an ideal means to preserve wealth. Growing participation in gold ETFs, digital gold, and institutional holdings, especially if macroeconomic uncertainties persist, can sustain or increase prices. Especially in a world where conventional currencies are being questioned by cryptocurrencies, gold can be the safest asset to retain value. But perhaps the biggest reason for another potential bull run in gold will be a global recession. Recession signals are flashing everywhere, and during recessions, gold usually outperforms all asset classes. 2000, 2008, 2020 are all recent examples, but this can be traced all the way back to the 1970s, before India's stock market even existed. So, should we just continue to buy gold, or maybe silver is a better option? Well, there are arguments to both sides. In terms of price and accessibility, silver is a much cheaper option, so it is easier for small investors to buy in quantity. Gold, on the other hand, is more expensive but more value dense. So silver wins for small investors, while gold is for whales. For volatility and returns, silver is more volatile. Price swings are larger, both up and down. It can outperform gold in bull markets, but fall harder in downturns. Gold, on the other hand, is more stable. So for short-term investors, it would be silver, while for long-term investors, gold makes a better bet. In terms of industrial demand, around 50% of silver's demand comes from industrial uses: solar panels, electronics, EVs, medical, etc. So prices can rise with tech and green energy growth. This can also make silver more sensitive to economic downturns though. Gold, however, is mostly used for jewelry and investment, with limited industrial demand. So in a recessionary environment, gold might be a better bet. As an inflation hedge and store of value, gold is historically the best hedge in the world, which is why central banks hold gold and not silver as reserves. Silver can also serve as a hedge, but is less trusted by institutions, so a better inflation hedge would be gold. But perhaps most importantly, the gold to silver ratio trumps almost every other point here. Historically, silver to gold price stands at about 25-1. Recent years, this has been 90-1. This makes some investors believe that silver is undervalued relative to gold and might catch up. That is my belief as well.